Oops. There we go. Looks a little funny here for some reason. All right. Well, we'll go ahead and get started on Chapter 9. Yeah, Chapter 9 is on tax credits. And we'll get to that for just a second. I'm going to stay on after, I think, a little, for those of you that you want to go over a little bit more on the Chapter 5. I gave you those two for the exam. If you have any questions on them, we can go over them. But so anyway, Chapter 9. Oops, let me grab a different camera here.
I just have one question.
Sure.
On Chapter 5.
Yeah.
Where are we supposed to put the union dues?
Nowhere.
Nowhere? They are not deductible?
Nope. Yeah, they took away a lot of the deductions that people used to have, business ones. So yeah, those are deductible, and the casualty loss, I think it was guitar, I believe it was. Those are only for natural disasters now. That there are national disasters that are declared. So you don't do anything with that either. There's no casualty loss. So yeah, they really tightened up a lot of that stuff. But at the same time, they gave the generous standard deductions. And you'll notice, those are very generous, but they're also, if people who itemize have to go over that, so that, it really was a benefit to most people. Okay.
Okay, thank you.
Okay. Okay. 1 second here. My printer curls up my pages. Okay, so we're going to talk about tax credits, and there's a number of them now. And tax credits they're better than deductions generally because they come off $1 for $1. We'll go through this here in a second and you kind of see what I mean by that. But tax credits are generally better. There'd be a very unusual circumstances where they might not be, but I'll talk about later. But 99.999% of the time, they're going to be better to have a tax credit than a deduction. Okay, so tax credit, 100% deduction is not tax deduction and offers only a portion of it. So if we had, focus. All right. Okay, so tax credit. So tax credit of $600. Marginal tax on any of that. So this is what their bill was. The $6,800 was the bill. Taxpayers' total photo withholdings was $5,800. So they owe $1,000. Now, if the tax is a credit, let's say credit. Credit comes off 1-to-1. So benefits from the credit. When a tax is owed. Example 2 is a similar one. Okay, now this is for deductions. Now deductions, you write them off your income, and then your income gets taxed. So these deductions will come off at the tax rate. So the benefit from this would be $600 times, I'm gonna change that to 0.22. Just move the decimal over. If you have a good calculator, you can just punch it in as 22%. But whatever that is. So you can see that if you had a choice between a tax credit for $600 and a tax deduction like we've been working with for $600, you'd obviously want to do the tax credit. It's a bigger bang for the buck. So tax credits are good because they come off dollar for dollar. Deductions are good too. They just don't. They're just not as good for a dollar amount. Okay. So I think today will be a shorter class. We'll see though. I hate to say that and go long or something. All right. Now tax credits. They come in two different flavors, and they come in non-refundable tax credits versus refundable tax credits. So they come off dollar for dollar. However, some of them are not like paying dollars in that you'll get back. If they're non-refundable, they can only be used to cover your taxes, and anything above that, you lose. So for this one here, we have this orange. We have a non-refundable tax credit, so it's for $6,000. Now the tax bill is only for $4,800. So that's the most that we can take for our tax credit. So the 4,800 is the most that we can take. And you'll notice if we get a refund of that and a refund of that, based on this, the taxes there, it comes out to 5,300. What you'll notice is basically they're returning your withholdings. You know, the tax credit takes care of all your taxes. You don't get the extra $1,200, but it takes care of all your taxes. And so basically they're just going to return your withholdings, saying, look, the credit covered them. You get all your withholdings back. So if it's non-refundable, you cannot get a refund for anything going over your taxes. Now it's still going to be better than this. So you say, okay, well, I don't like that I lost out on that. Well, usually, you know, this is going to be a bigger amount anyways. So for instance, if you had the $6,000 of a deduction, and you get 12%. That's a 2, by the way. So even though you may be mad, there's someone you probably would be mad, but well, gee, we lost, $1,200. It's still going to be much better than, generally going to be much better than a deduction. The only time a deduction might be better is if your taxes are basically zero. So if you have a zero tax bill and you paid out money, for instance, out of your bank account or something like that, you might get the deduction that you could then apply, and you might get a little bit, back based on that deduction. But again, it'd be a very weird situation, and the tax bill would have to be very low for a deduction to actually be better. It's one of those things that I guess theoretically could happen, but it'd be very unusual, I would think. And another thing working against it is as your income goes down and down and down, the tax rate does too. So this becomes, any write-offs you have become less and less and less. Okay. Now down here it says, what if it is a refundable credit? So if it is a refundable credit, this is going back to, I probably should have put these two close together at the opposite ends of the paper. If it is refundable, you can get the whole amount. So if it's not refundable, the most you can get is for the tax amount, then they basically give you your withholdings back. Down here, you get the full amount. So basically what you get back are your withholdings plus that $1,200 over that they paid for this. So this is where they get that, your withholdings plus the $1,200. They refunded you $1,200 that you didn't pay in, basically. So, the best tax credits you can get are the refundable credits that, because you can use the whole thing, even if it goes over your tax bill. People have pointed out that you're basically taking taxes away from other people. You do that because you're getting $1,200 more than you paid in. Now, the reason they give these credits, though, is to encourage some behaviors, or it's because of financial difficulties and that sort of thing. So it's not like they're just giving out, willy-nilly. But so anyway, so these are refundable versus non-refundable. Non-refundable can only be used for the tax bill itself. Anything above that, you lose. You still will get your withholdings back, though. So you'll still get the withholdings back, and that's basically what this $5,300 is. All right. All right. These are some of the, the question comes up. Well, sorry, but which one of these are, some of these are refundable, some of them are not, and which are which, and most of them you'll see are non-refundable. You can use them to pay your taxes, but anything over your tax bill, you lose them. There are some that are refundable. One of those we'll talk about today. And then partially refundable tax credits are these two. There's the child tax credit. I think we saw this chapter 3 maybe. They gave a funny one where they basically it's the child tax credit is $2,000 and $800 of it is refundable, which I had written that legibly. So you get a $2,000 credit, but let's say that you go over your taxes. So if you can't use this for your taxes, the $800 you can still get a refund of up to $800. But anyway, we'll talk about that later. But the so some of these are partially refundable. Okay, let's go to the first one. And the first one is more. It's a little bit confusing until you kind of, when you think about it, it kind of makes sense. Okay, so this is the credit for child and dependent care expenses. So it could be a child, it could also be another dependent. And basically it's for when somebody goes to work. So it's someone who pays for a child or dependent care while they're at work. So, and you'll notice that in a bigger sense almost looks like a business expense. That, if somebody goes to work and they have to get paid for childcare while that childcare, so it was thought that they should get some kind of a credit for doing that. Okay. To qualify for the credit, the taxpayer must incur employment-related expenses. So you have to have expenses to apply for this credit. So if you don't have any expenses relating to this, you don't get the credit. So the question is, what are qualifying expenses? Well, all necessary expenses. Babysitters, housekeepers, cooks, nannies, those all count. So if you're paying a babysitter, you don't want to work at 5, your child gets out of school at 3 o'clock and you have a babysitter, that counts. Now, if it is a family member, such as a grandmother, you can still pay them and they count that as an expense as long as they're not a child under the age of 19, so 18 or less, and they cannot be claimed as a dependent. So dependents are not, you can't pay dependents, and that they are over the age of 18, basically. So as long as they're 19 or older, you can pay them and count it. If they're not, so you have a 10-year-old son and your 17-year-old daughter babysits, you can't count it. One thing, they're probably both the babysitter's probably a dependent. Second thing, they're a child and they're under the age of 19. All right. And in case you're wondering, well, why is that like that? Why if I pay, what's the difference? If I pay grandmother or if I pay my daughter, what's the difference? The difference is that they're dependent and they're in your house, that money is basically in your house still. It may not be maybe with a different person, but it's basically still in your house. Whereas if they're not a dependent, grandmother goes back to her house, that money's no longer in your house. Okay. This one's a little bit technical. It looks a little blurry to me. It could just be that I can't see, but so this one, if the expenses are incurred outside the home, so you take someone to a dependent care facility that provides care for a fee for 6 or more individuals. So we're talking about a real business. The expenses qualify only if the facility complies with all the applicable state law, local laws for licensing. So if it has 6 or more people that attend, that attend it, it has to be licensed or else it doesn't count. So if it has 5 or fewer, you don't have this rule, but if it has 6 or more, they must be licensed. Okay. In addition, out of the home expenses incurred while caring for an older dependent or spouse who is incapacitated qualify. However, qualifying individuals must live in the household of the taxpayer for at least 8 hours a day. So it cannot be something where they're, in a home or something like that, where they never come, they're never in your house. So for this credit, this is for when you go to work, you can't leave them alone. They have to be in your house for at least 8 hours a day. And these rules allow for credit for expenses for an incapacitated dependent who would otherwise be institutionalized. So a lot of times, people would rather take them to a day center, and then bring them back home rather than leave them in a center, completely. Okay. Man, there's a lot. I thought I had more examples here. Where's that going? Okay, there's kind of a lot here. There's one of those things that, it's a good thing, but it's one of those things that you try, explaining, especially explaining to someone who's not sort of a numbers person, can get a little wacky. Okay. Qualifying individual. Person who is under the age of 13. So someone who's under the age of 13, who is a dependent of the taxpayer, you can count that. If they're 13 or over, the idea is that they can probably take care of themselves. A dependent spouse who is incapable of caring for him or herself, and they live at least half the year. So if you have a spouse that is incapable of, if they have MS or something like that, that they are incapable of caring for themselves, that also counts. So a child up to 12 years old, someone who cannot take care of themselves. And this one is basically thrown in there. Divorces are somewhat common, so you might run into something like this: that a child under the age of 13, meaning the special dependency test, or divorced parents need to qualify an individual for the custodial parent, even if that parent cannot claim the child as a dependent. So even if they don't give at least half of the care of the child, but they have the custodial rights, they are the ones that get the qualifying exemption. So whoever is a custodial parent, the idea is that the custodial parent are the ones that arrange for babysitting and that sort of thing. Generally, married taxpayers must file a joint return to claim the credit. Legally separated taxpayers are not considered to be married. So if there's a legally separated one, this is actually a court document. There's legally separated. There's actually people that can be actually, even though they're going through a divorce, still could be declared to be single. But they drag on for years and all that. Okay. So now comes the crazy part. So we kind of know who it is. It's for people that, for children and 12 years old or younger, and for people that they're dependents that can't take care of themselves. Okay. Maximum expenses that can be claimed. One dependent, 3,000. Two dependents, 6,000. Now, there's another, so this is the first one, so they can't be more than this. Now they can be less than this, you know. So just kind of giving you little examples here. If this was, if you had expenses of, let's say 7,000, you know, the max you can take, if it's, well, I guess it's whether it was 1 or 2. Let's say it's for a 2. The max you could take would be 6,000. If your expenses were 3,600, the max is 6,000, but the 3,600 is the most you can take. So these are the maximum amounts. You can have less than that if you have less expenses. You can have less than that, but you can't go more than that. If married, the maximum qualified expense can not be more than the individual spouse's lowest earned income. In other words, the dependent care cost should not exceed either the spouse's earned income. The idea being, if you're paying more for child care than the spouse is making, it would make sense for the spouse to quit working, and you'd save money, you know, by doing that. That's the theory, anyways. So, you know, that's why this is like, so it's the lowest earned income for the spouses. Well, the question is, what is in earned income? Earned income for most people are going to be either wages or from self-employment. These other two could happen. Yeah, but these are probably the two most usual ones: wages, or if you have your own business. And this one, disability from retirement benefits received prior to the minimum retirement age. So this is if, for instance, you are on disability and you're 52, that's where that one would kick in. Union strike benefits, these are benefits the union pays to their people when they go on strike. If you're not in a union, you don't have those. Even if you are in a union, a lot of times you don't have those. So, all right. All these things down here are not earned. So, you know, things like interest and dividends and all that kind of stuff. And by the way, when they talk about wealthy people, a lot of times this is what they're talking about. A lot of times wealthy people, you know, this is where they make their money, interest and dividends and that sort of thing. You know, so a lot of times they'll say these people, they don't have much earned income, but they have a lot of this, what they call unearned income. So anyway, these are not included in it. Now notice that when we're doing these, they're the maximum. So you actually want these to be high for this part. Okay, you know, you want this to be high enough that you can actually take the full maximum amounts. Okay, so these are things that are not in there, but so coming down here now, and this one might seem a little funny or not funny, but might not seem good, except when you start to think about it. If the spouse is unable to care for him or herself, or is a full-time student, so if they can't care for themselves, or is a full-time student, you say, well, wait a minute, those are two completely different things, right? The spouse is deemed to have earned income in the following amounts. If it's one dependent, $250 a month. 2 plus dependents, $500 a month. Now you say, well, why is that? Why would they, you know, somebody who can't care for themselves, and you're saying that they have income of $250 a month? This is actually good for them, because this will increase their earned income, you know, by $250 a month. And if you think about it, $250 a month times 12 is $3,000. this is good for them. If, notice if they were unable to care for themselves, their income would probably be zero. And if you didn't do something, they couldn't get any of this because it would be, if they were the spouse and they were get zero, the lowest spouse would be zero. So this would be zero. They wouldn't get any tax credit. So this is good that it's imputed. Now, no, they don't actually pay taxes on that. It's only for this, the child tax credit that is in there. And so, and you see, like, this is the 2+ dependents is, same thing. So what they're saying is, if you are unable to care for yourself or a full-time student, and again, the reason being, if someone goes to school, they certainly have somebody who watches children when they're at school, so forth. So a full-time student, they also get these. Now, full-time student, it goes by the month. So if you're in school for 8 months out of the year, you multiply by 8. But anyway, the idea is that this is actually good. They're not actually taxed on this, but they use this for this calculation. And you want the maximum, you want to get the most out of it. Okay. Maximum qualified expenses are reduced by any employer reimbursement. You probably didn't need to put that one in. That's kind of the way it is when someone else reimburses you, it's not really an expense of yours. So, but this will reduce whichever one of those you're at. So for instance, you pay $7,000 and your employer reimburses for 2, it'd be 6,000 minus the 2, you'd be down to 4,000. Okay. Okay, so let's take a look here. Finally, a problem. Yay! Okay, Eric and Tina have 3 qualifying dependents. Care total 8,300. Eric's income for the year was 38. And Tina's earned income for the year was 62. What amount of qualifying expenses can Eric and Tina claim? Okay, well, back to our sheet here. They have 3 qualifying dependents, so it's 6,000. However, it cannot be more than the individual spouse's lowest earned income. And you'll notice that Eric's income was 38. So that is going to be the most that they can have for qualifying expenses. And notice something. This 3,800, logically, now you don't know their situation really or anything, but logically you'd say, okay, if Eric's making 3,800 and they're paying out 8,300 for childcare, it would make more sense for Eric to quit work and they could save $8,300. They'd be better off by whatever the difference is there. So this is the idea behind it. Why don't we say, well, why is that reduced down to that? And the idea is that at some point this will get low enough that that person probably shouldn't, if it does go down low enough, it probably at some point this person should probably be taking care of the kids or whoever else that they have there, that rather than paying out. Now, again, they don't have to, but this is all they're going to get for the qualified expenses. Okay. Oh, 7. Jill and Jack have 1 qualifying dependent. That's the wrong there. That should be the, I think. The dependent care expenses for the year totaled $3,300. Jill was a full-time student for 10 months of the year, and Jack had earned income for the year of $53,800. Okay, so the max is 3,000. So, they can't take all 3,300. The most they can take is 3,000. Jill's a full-time student for 10 months. Okay, so we're here. They have 1 dependent. Jill's a full-time student, so Jill can take $250 per month as, oops, $2,500. So they can't take the max, but they can take $2,500. And this is why that's in there. Notice that if you didn't have these rules here, this would be 0. Because if what is this? Yeah, because if Jill didn't make any income, but she's a full-time student, without this rule, they wouldn't get anything. But with this rule, they say, okay, if it's for 10 months, that your imputed income just for this, she's not going to have to pay taxes on that. But for this, it's going to be $2,500. So that's a good thing. Okay. Now, this is where things get even wackier. Once you get the qualified expenses, you're going to multiply them by the applicable percentage. So you're going to qualifying percentage, scratch that. Qualifying expenses times the applicable percentage. And that's going to equal the credit. So the credit isn't for the full amount. So if you get 2,500, you're not done. These are the percentages. And you'll notice that they go up to 43,000. When you make over $43,000, the applicable percentage is 20%. So even if you make $15 billion, you still get 20% of whatever this is as a credit. And as it goes down, you get more of a credit. So in other words, the less money you make, the more you get back as a credit, which is what you would expect and what would be fair. The less you make, that you get more of a credit for it, because the ability to pay is that sort of thing. Okay. This one down here is all of it together. Okay. So Argentina, they have 3. I think I just copied that one. I did. Argentina have 3 qualifying. This is a different Argentina. This is these are 2 completely. It's happy coincidence. Wouldn't be like I didn't just copy and paste it. Okay, that's what I did. All right, so the expenses for the year totaled 7,300. Now, of the 7,300, 4,100 was paid to Aunt Sally. Aunt Sally is not a dependent of Eric and Tina. Okay, well, can we pay Aunt Sally? Yeah, we have 2 pages. Where's Aunt Sally? Oh, here. This is on page 3. So here's Aunt Sally. Paid to a family member, as long as not a child of the taxpayer. Well, Aunt Sally isn't, and cannot be claimed as a dependent of the taxpayer, which she can't. So there's no problem paying $4,100 to Aunt Sally. It counts as expenses. Eric's earned income for the year was $28,800. That's way more than the $6,000. They have 3 kids, so the max is $6,000. Okay, Tina's it was 47, so again, way more than the max. That's not going to be a problem. Eric's employer reimbursed $1,800 for childcare. They have to take that off. So reimbursed. Green one. Let's do green. Okay, so $4,200. So these are going to be the qualifying expenses. Now notice something here. The 1,800 does not come off of the 73. You know, they pay 7,300. The max they can get is 6,000. This 1,800 comes off of the 6,000, not the 7,300. Okay, so when you reimburse, it comes off of these amounts. Okay, so qualifying expenses are 4,200. And they had adjusted gross income, which you can't read on the screen now because it's too dark. Let me lighten this up a little, maybe. You can't read anything. Yeah, that looks worse. Okay, all that enough. Okay, so $71,000. Now you notice that that's way over the 43. So they're looking at 20%. Oops. $840. So that's going to be their credit. And again, that's dollar for dollar, whatever they pay. We don't have whether they pay their taxes here, but their taxes, it'll be reduced dollar for dollar for 840. Now, even though we talk about how the tax credits are better than deductions, they could, if you look at this one, they're kind of the same a little bit in that they still use a rate. usually, and then this one they have a rate here that they multiply by. So even though, the credit itself is a one-to-one takeoff, 840 is the one-to-one takeoff. If you actually look at the expenses, it's not, this is not the credit, that is. So the credit itself is a one-to-one, but coming up with that calculation sometimes is reduced a little bit. Okay, one more thing. Oh, I thought I finish quicker. Sorry about that, guys. Page 3. Credit for the elderly or the disabled. This is one of those things that it's there to help people that are have a very low income, and that it's there to help them basically. So credit for the elderly or disabled was enacted by some tax relief, and they must be one of two things. At least one of two. 65 or older, or be permanent disability. So either one of those will qualify. Okay. Maximum allowed credit, 15% of the taxpayer's base amount, depending on the filing status. Okay, so these are the base amounts. I won't have that labeled very well. Okay, so $5,000 for single individuals who join filing joint returns when only one qualifies. Okay, so here you have two people, but only one of them meets those criteria. Only one of them does. You get $5,000 to start out with for that. This one is if both of them do. And any combination is fine. So this is when both people, any combination of these, two of these and two of these, or one. So this is when both of them do. And this is if they're married, person filing a separate return. This is also for single people, though, $5,000. But so basically, it's when there's one person who is in this category. Okay, now the base amount must first be reduced by non-taxable Social Security benefits. So it's very possible someone may have a lot of Social Security benefits that aren't taxable. Those are going to reduce this amount, or whichever one we're at. 1/2 of the amount of AGI, the AGI is the adjusted gross income. Oops. This is basically the amount, if you remember back to our 1040, before we take the standard deduction, that's the adjusted gross income. So before the deduction comes in, the standard deduction or itemized deduction, before that comes in, that's your adjusted gross income. 1/2 the amount of AGI that exceeds $7,500 for single returns, $10,000 for joint, and $5,000 for married filing separately. Okay. So coming down here, Samantha and Thomas are both over 65. Okay, so we got two of them. They're both All right, so this will be the max, will be 7,500. We have to reduce that by the non-taxable Social Security. And then also their adjusted, 1/2 of their adjusted gross income over wait, that's the one that read after. Okay, so their AGI was 14,000. The joint return amount is 10. The over is 4,000 times 1/2. Okay, so that's the most. It was reduced by the Social Security, reduced by the AGI. And that is what we come up with for it. So 75 minus 19. So 3,600 is what's left of the base, and 15% of that. $3,600 times 50. So this is going to be their credit. You'll notice something as this AGI goes up, as they make more and more money, at some point, this will reduce this down to 0. Right. Yeah. So at some point where this comes, as this gets bigger, the AGI, this becomes less and less and less. I'll figure it out. The equation will look like this. So this is for joint.
I want to do this now. 0.5x minus half of that. Add 5,000 each side. Oops. Bad math here. I get rid of that and multiply both sides by 2. That's wrong.
Has 2,500. It's supposed to be 7,500.
Oh, yeah. Oops. Whoopsie. Okay, so this would be 12,500. Let's try that again. So 0.5 x equals 12,000. That looks more like it. Multiply each side by 2. That's it. All right, so if your AGI is above that and you're married, you know, you can't get it. It's possible you can't get it if you have these in these Social Security payments in there too. Look at that, I didn't bring that down correctly. All right. So yeah, so you notice, I mean, this is really to help people that are lower income.
Can I ask a question?
Certainly.
Okay, so where did you get the 15% at the bottom?
That's just how they do it. The maximum allowed credit is equal to 15%.
Oh, got it. Okay, that's the standard. Thank you.
Yeah, it is a weird. And again, you know, we talk about these tax credits that, you know, they're 1-to-1 they take off. So that this tax credit down here will come off 1-to-1. However, when they do the calculations, you'll notice that it's very similar to, you know, writing off at a tax rate. You know, for instance, if you were able to write this $7,500 off as a deduction and your tax rate was 15%, the benefit would have been the same. So now, if you look at just the credit itself, it's 1-to-1. This can write off, you know, this will save you $540. But yeah, so there's almost always this, and you'll notice that too with, you know, with these. You get the qualified expenses, but then you multiply it by some rate. So even though the credit itself is 1-to-1, actually coming up with the credit, there's usually some, you know, reduction of it.
Thank you.
You're welcome. Okay, question on that? Okay, this is also kind of a big chapter. So we'll probably take 3 days on this one too. How many days we have left? I should probably know that, right? What are we on? Are we week 12? Let me take a look, see here. Yeah, we're in week 12. So we got 4 more. I'll take a look. I'll make sure that we get all the stuff. We're actually pretty close to getting all the stuff we need to get in anyways. Shouldn't be too bad. Okay, yeah, but this is a big chapter. This has got a lot of stuff. And this is a lot of the stuff are things that you'll you know, see doing taxes for people. So you know, it's good stuff. Okay, so we'll start up next week on it. If you have, again, those the 2 problems for the chapter 5 exam, if you have any questions on them, you can email me if you want to stick around. I'll go kind of answer any questions you have on them. But basically, the 2 things that really come up are the union dues, and then also the casualty loss, the guitar. In the past, they could write those things off. Now they can only write off casualty losses if it's a nationally declared disaster. It has to be nationally declared disaster before they can write it off. So that's the only time that they can have it. And having said that, you do not have to fill out the form for casualty loss if it wasn't, you know, if they're not going to be able to take it. All right. Well, if you have any questions, feel free. If you want to stick around, stick around, and if you have any questions, we'll go over them. But that's it for the chapter 9 handout.
Can we leave?
That's right.
Yeah, I said, is it, that's it for tonight?
Yeah, that's it for tonight. Unless you have any questions on the chapter 5 exam, that's it. Yeah, but yeah, so if you want to stick around, if you have any questions on it, otherwise I'll put the dancing dog so we all know that, you know, it's time to go.
Okay, have a good night.
Have a good night.
Okay, bye-bye.
I have a question on problem 2.
Let me pull it up here. So this one?
Yeah. So I don't know. I just don't feel like confident on knowing which medical costs are included. Like on the first example, or no, the third example, I think. So there were a couple of things like vitamins and over the drug, they were not included, health club fee not included. So I'm just wondering for problem 2, if there were which ones not included. I'm just not sure where to look off of to know, because I'm not sure if that's
Yeah, basically all these are going to be okay, but they're going to be reduced by the insurance premium, the insurance reimbursement.
okay.
So
I just wasn't sure which ones we were excluding, if
yeah,
any.
yeah. Let me switch cameras here. Oops. Let's see it. Oh, here. Yeah, so this is that Excel thing I said.
Mm-hmm.
Yeah, so for this one, basically, you're going to just take all of these. You know, that'll be all in there, whatever that comes out to. And then this will be the subtracted.
Got it.
And again, yeah, that's yeah. So that's in this reimbursement. This is something that you come across time and time again. If the employer reimburses it, if you didn't actually pay it.
Right.
The employer gets to write that off. You don't. So, yeah. So that would be their medical. But yeah, over the counter vitamins and things like that, and like health club stuff, and that generally isn't, unless it's prescribed.
Understandable. Okay, I just wasn't sure if there was like a trick in the problem, you know what I mean?
Yeah.
And then as far as the taxes, were those all included too? Because I know you mentioned the union dues weren't. Um,
Yeah.
But I mean, like tax preparation fees,
Nope, no longer.
that's what I thought.
Yeah, and that's probably why they threw this in there. They throw in those things that, you know.
Okay, thank you. Yeah, those were just my questions.
Okay.
Everything else is pretty standard, I think.
Good.
Thank you.
Let's wait a minute. Any other questions? I can't, I took my camera down. There we go. Okay. Well, if there's no questions, I will talk to you later. If you do come up with any questions, you want to email me. And by the way, I don't mind doing Zoom meetings or, you know, we're got a time to do them. So if you want to do a Zoom meeting, that's fine too. But otherwise, you can email me or whatever, however you want to do it. All right.
Thank you.
There. Good night.